They gave mortgages to people with no jobs, packaged the debt like candy, sold it to the world, and when it all collapsed, 8 million Americans lost their homes. This is the story of the 2008 housing crisis, the biggest financial disaster since the Great Depression. And the wildest part? The people who caused it got bonuses, while families slept in their cars. Suburban America, early 2000s, white picket fences, two-car garages, and a promise. Own a home, build wealth, live the dream. For decades, that's how it worked. You saved 20% for a down payment. Banks checked your income, your credit, your job history. If you qualified, you got a 30-year mortgage at a reasonable rate. Miss payments? You lost the house. It was simple. It was stable. It was boring. But then something changed. Interest rates dropped to historic lows after 9/11. Money became cheap, really cheap. And when money is cheap, people want to borrow. Banks want to lend. And suddenly, everyone's looking at houses. Here's where it gets interesting. Banks ran out of qualified buyers. Everyone with good credit already had a mortgage. So they looked down, way down, introducing subprime mortgages, loans for people who couldn't actually afford them. No job? No problem. No income verification? We'll take your word for it. Bad credit? Here's a loan anyway. They were called ninja loans. No income, no job, no assets. Yes. Really. Maria worked part-time at a diner making $24,000 a year. She got approved for a $300,000 mortgage. How? The broker just wrote down $84,000 on the application. Nobody checked. Nobody cared. Because Maria wasn't going to be their problem for long. Here's where it gets wild. Banks weren't keeping these risky loans. They were selling them immediately. It worked like this. Step 1, bank gives Maria the mortgage. Step 2, bank bundles Maria's mortgage with thousands of others. Good ones, bad ones, terrible ones, all mixed together like a financial smoothie. Step 3, they slice this bundle into pieces called mortgage-backed securities. Step 4, they sell these securities to investors around the world. Pension funds, insurance companies, retirement accounts, everyone wanted in. Why? Because they were told these were safe, AAA rated, as secure as U.S. Treasury bonds. But here's the secret. They weren't. They were packed with subprime garbage. But the ratings agencies, the referees of Wall Street, they stamped them AAA anyway. Why? Because the banks paid them to. It's like paying the health inspector to approve your restaurant. Spoiler alert, the kitchen was full of rats. Now everyone had a reason to lie. The home buyer lied about their income because they wanted the house. The mortgage broker lied on the application because they got a commission for every loan. The bank lied about the risk because they sold the loans immediately. The ratings agencies lied because the banks paid them millions. And Wall Street? They packaged the lies, wrapped them in complexity, and sold them as innovation. But it gets worse. Wall Street got greedy. They created something called CDOs, collateralized debt obligations. Basically, they took the worst slices of mortgage-backed securities, the ones nobody wanted, and repackaged them into new securities. Then they got those rated AAA, too. It's like taking spoiled meat, grinding it up, reshaping it, and calling it prime steak. And people bought it. Billions of dollars worth. One investor, a guy named Michael Burry, actually read the mortgages inside these CDOs. He saw adjustable rate mortgages that would reset in 2 years. He saw borrowers who could barely afford the first payment, let alone the higher ones coming. And he realized something terrifying. This whole thing was going to explode. By 2005, housing prices were skyrocketing. A house that cost $200,000 in 2000 now cost $400,000. People weren't buying homes to live in, they were flipping them. Buying today, selling 6 months later for a 30% profit. HGTV made it look easy. Everyone wanted in. Your dentist was a real estate investor. Your yoga instructor had 3 rental properties. Banks were practically begging people to borrow more. Take out a home equity line of credit. Buy a second home. Refinance and pull out cash. Spend it on boats, cars, vacations. The house will keep going up in value. It always does, right? Except it doesn't. It never does forever. Meanwhile, the red flags were everywhere. In Las Vegas, homes sat empty. In Florida, entire developments had no residents. In California, strawberry pickers were getting approved for $720,000 mortgages. But Wall Street kept selling, the ratings agencies kept stamping, and the music kept playing until it didn't. Early 2006, something shifted. Home prices stopped rising, then they started falling. Just a little at first, 2%, then 5%, then 10%. For the first time in decades, houses were worth less than people paid for them. Now remember Maria?
Oh my
Her
God.
adjustable rate mortgage just reset. Her monthly payment jumped from $1,200 to $2,400. She was already struggling at $1,200. At $2,400, impossible. She missed one payment, then another. Then the foreclosure notice arrived. Maria wasn't alone. Millions of subprime borrowers hit the same wall at the same time. Foreclosures exploded. 2006, 1.3 million foreclosures. 2007, 2.2 million. 2008, 3.1 million. Entire neighborhoods became ghost towns. Lawns turned brown. Windows boarded up. For sale signs everywhere. Nobody buying. And those mortgage-backed securities, the ones rated AAA, they started failing. Because when Maria stopped paying, the security stopped paying. And when millions of Marias stopped paying, the securities became worthless. March 2008. Bear Stearns, a Wall Street giant for 85 years, collapsed in 4 days. They were drowning in mortgage-backed securities nobody would buy. The Federal Reserve had to arrange an emergency sale to J.P. Morgan for $2 a share. 6 months earlier, it traded at $170. But that was just the beginning. Lehman Brothers was next. Founded in 1850. Survived the Civil War, 2 World Wars, the Great Depression, but they couldn't survive subprime mortgages. September 15, 2008, Lehman filed for bankruptcy. The largest bankruptcy in American history. $600 billion gone. Overnight. Panic spread. Banks stopped lending. Businesses couldn't make payroll. The stock market crashed. Retirement accounts evaporated. Credit froze. The entire financial system was on the verge of collapse. Then came the bailouts. AIG, the insurance giant, got $182 billion. Bank of America, Citigroup, Wells Fargo, all got billions. The government called it necessary. The public called it a robbery. Because while banks got bailouts, homeowners got foreclosures. Meet Jennifer. She was a teacher in Ohio. Saved for 10 years for a down payment. Bought a modest 3-bedroom in 2006. By 2009, she owed $180,000 on a house worth $90,000. She kept paying anyway, for 3 years, every month. Until the school laid her off due to budget cuts caused by the crisis. She lost the house. Lost her savings. Lost everything. Or Mark, a veteran who bought his first home in Arizona. Adjustable rate mortgage. He didn't understand what that meant. When the payment jumped, he worked 3 jobs trying to keep up. Had a heart attack at 42. Hospital bills buried him. Foreclosure followed. 8 million Americans lost their homes. 13 million lost their jobs. Trillions in wealth vanished. Suicide rates jumped. Families split apart. People lived in their cars, in shelters, on couches. An entire generation watched their parents lose everything. The damage wasn't just financial. It was psychological. A whole generation stopped trusting the system. But the executives, they kept their jobs, kept their bonuses. Some even got raises. Not a single top Wall Street executive went to jail, not one. After the crash, investigations started. Congressional hearings, FBI probes, journalists digging through the wreckage. And what they found was stunning. Emails where traders called their own products crap and junk while selling them to clients. Internal memos showing executives knew the mortgages were fraudulent. Ratings agencies admitting they never actually analyzed the securities they rated. One email from a Standard & Poor's analyst said it perfectly. We rate every deal. It could be structured by cows and we would rate it. Angelo Mozilo, CEO of Countrywide, the largest subprime lender, made $470 million between 2003 and 2008. He called his own loans toxic in internal emails, then sold them anyway. His penalty? A $67.5 million fine, which his company paid. He kept the rest. He never saw a courtroom, never saw a cell. The public demanded justice. They got speeches. They got apologies without consequence. They got told it was complicated, too big to prosecute, too interconnected to punish. The government spent $700 billion bailing out banks through TARP. The Federal Reserve pumped trillions more through quantitative easing. Eventually, the economy stabilized. Banks recovered. Stock market. Families who lost homes couldn't qualify for new mortgages because foreclosure destroyed their credit. The same banks that caused the crisis got the houses back for pennies on the dollar, then rented them out at inflated prices. Young adults stopped buying homes entirely. Millennials became the renter generation, not by choice, but because they watched their parents lose everything. Home ownership rates dropped to levels not seen since the 1960s. The American dream didn't die in 2008, but it definitely flatlined. Here's what should have happened: stricter regulations, criminal prosecutions, fundamental reforms. Here's what actually happened. Dodd-Frank, a 2,300-page law that banks immediately started lobbying to weaken. Some regulations passed. Most got gutted within a decade. By 2024, we're seeing familiar patterns. Housing prices at record highs, buyers stretching budgets, new financial products with innocent names and complicated structures. Different players, same game. Because the lesson Wall Street learned wasn't "don't do it again." It was "make sure the bailout is bigger next time." Michael Burry, the investor who predicted the crash, recently said, "I may have been early, but I wasn't wrong." And I'm seeing the same patterns again. The 2008 housing crisis wasn't a natural disaster. It wasn't an accident. It was the result of systematic fraud, regulatory failure, and unchecked greed. Millions of people lied. Millions more looked the other way. And when it collapsed, the people who caused it got rescued while the victims got evicted. Maybe the scariest part isn't what happened. It's what didn't happen after. No real accountability, no structural change, just bailouts, bonuses, and back to business. We didn't learn the lesson. We just waited for the cameras to turn off, because deep down the system worked exactly as designed. Profits privatized, losses socialized, risk for thee, but not for me. And somewhere right now, someone's bundling debt they don't understand, getting it rated by someone who isn't looking, and selling it to someone who doesn't know. History doesn't repeat, but it sure does rhyme.